What is trade? Transactions are a basic economic concept that involves buying and selling assets. These may be goods or services that the buyer pays the seller. In other cases, the transaction may include the exchange of goods and services between the parties to the transaction. In the context of financial markets, the assets traded are called financial instruments. These can be stocks, bonds, currency pairs on the forex market, options, futures, margin products, cryptocurrency, and many others. If these terms are new to you, don't worry, we'll explain them all later in this article. The term trading is commonly used to refer to short-term trading, where traders actively enter and exit positions over relatively short time frames. However, this is a slightly misleading assumption. In fact, trading may refer to a wide range of different strategies, such as day trading, swing trading, trend trading, and many others. But don't worry, we'll go through each of them in more detail later. What is investing? Investing is allocating resources with the expectation of generating a profit. This can include using money to fund and kickstart a business or buying land with the goal of reselling it later at a higher price. In financial markets, this usually means investing in a financial product in the hope that it will be sold at a higher price later. Expectations of returns are at the heart of the investment concept. Unlike trading, investments usually take a longer term approach to wealth creation. The investor's goal is to accumulate wealth over the long term. There are many ways to do this, but investors usually use the basic elements to find potentially good investment opportunities. Due to the long term nature of their approach, investors are generally not worried about short term price fluctuations. As a result, they tend to remain relatively passive without much worry about short term losses. Trading and investing, what's the difference? Both traders and investors strive to make a profit in the financial markets. However, the methods for achieving this goal are very different. In general, investors seek returns over a longer period of time. Think of them as years or decades. As investors have a longer period, their desired return on each investment also tends to be greater. Meanwhile, traders seek to take advantage of market volatility. They may enter and leave positions more often and seek lower returns on each trade. Which one is better? Which one is more suitable for you? That's for you to decide. You can start educating yourself about the markets and then learn by doing. Over time, you'll be able to determine which one suits better your financial goals, personality, and trading profile. What is fundamental analysis? Fundamental analysis is a method of assessing the valuation of financial assets. Fundamental analysts look at both economic and financial factors to determine if an asset is worth it. This may include macroeconomic conditions such as the state of the economy as a whole, industry conditions, or businesses related to assets, and these are often tracked by leading and lagging macroeconomic indicators. Once the fundamental analysis is complete, analysts want to determine if the asset is undervalued or overvalued. Investors can use this conclusion in their investment decisions. For cryptocurrencies, fundamental analysis also includes a new area of data science that examines public blockchain data called on chain metrics. These metrics include network hash rate, top holders, number of addresses, transaction analysis, and more. Analysts can use the wealth of data available on the public blockchain to create complex technical indicators that measure specific aspects of the overall state of the network. While fundamental analysis is widely used in the stock market or forex, it's less suitable for cryptocurrencies in their current state. This asset class is so new that there simply isn't a standardized, comprehensive framework for determining market valuations. What's more, much of the market is driven by speculation and narratives. As such, fundamental factors will typically have negligible effects on the price of a cryptocurrency. However, more accurate ways to think about crypto asset valuation may be developed once the market matures. What is technical analysis? Technical analysts work with a different approach. The central idea behind technical analysis is that past price behavior can provide insights into how the market may behave in the future. Technical analysts do not try to understand the intrinsic value of an asset. Instead, they look at past trading activity and try to identify opportunities based on it. This can include analysis of price action and volume chart patterns, the use of technical indicators, and many other charting tools. The goal of this analysis is to evaluate a given market's strength or weakness. With that said, technical analysis isn't only a tool for predicting the probabilities of future price movements. It can also be a useful framework for risk management. Since technical analysis provides a model for analyzing market structure, it makes managing trades more defined and measurable. In this context, measuring risk is the first step in managing it. For this reason, some technical analysts may not be considered pure traders. Technical analysis can only be used as a risk management framework. The practice of technical analysis is applicable to all financial markets and is widespread among crypto traders. But does technical analysis work? Now, as mentioned earlier, the valuation of the cryptocurrency market is mainly driven by speculation. This makes it an ideal competition for technical analysts as they can succeed by considering only technical factors. It depends entirely on your trading strategy. In fact, why not use both? Most market analysis methods work best when combined with other methods or indicators. In this way, you are more likely to find a more reliable investment opportunity. You can also combine different trading strategies to eliminate prejudice from the decision making process. This concept is sometimes referred to as confluence. Confluence traders combine multiple strategies into one that harnesses benefits from all of them. The idea is that the trading opportunities presented by the combined strategies may be stronger than the ones provided by only one strategy. What drives the financial markets? The price of an asset is simply determined by the balance of supply and demand. In other words, it is determined by the buyer and seller. The market is where supply meets demand. But what else can increase the value of financial assets? As already explained, there may be basic factors such as economic conditions. There are also technical factors such as the market capitalization of cryptocurrencies. Also, there may be other factors to consider, such as market sentiment or recent news. However, these are just that factors to consider. What really determines the price of an asset in a given moment is simply the balance of supply and demand. What is a market trend? A market trend is the overall direction where the price of an asset is going. In technical analysis, market trends are usually identified using price actions, trend lines, or key moving averages. In general, there are two main types of market trends, bulls and bears. The bull market consists of a sustained uptrend in which prices continue to rise. The bear market consists of a persistent downtrend in which prices continue to fall. In addition, you can identify integrated or flat markets that do not have a clear trend. It's worth noting that a market trend doesn't mean that the price is always going in the direction of the trend. A prolonged bull market will have smaller bear trends contained with it and vice versa. This is simply just the nature of market trends. It's a matter of perspective as it all depends on the time frame you are looking at. Market trends on higher time frames will always have more significance than market trends on lower time frames. A peculiar thing about market trends is that they can only be determined with absolute certainty in hindsight. You may have heard about the concept of hindsight bias, which refers to the tendency of people to convince themselves that they accurately predicted an event before it happened. As you'd imagine, hindsight bias can have a significant impact on the process of identifying market trends and making trading decisions. What is the market cycle? You may have heard the phrase the market moves cyclically. A cycle is a pattern or trend that occurs at different times. Market cycles in higher time frames are usually more reliable than market cycles in lower time frames. However, you can eventually find a small market cycle on the hourly chart, much like looking at decades of data. The market is cyclical in nature. Cycles can cause a particular asset class to perform better than other asset classes. In other segments of the same market cycle, the same asset class may fall below other types of assets due to different market conditions. Note that at some point it is almost impossible to determine where you are in the current market cycle. This analysis can only be performed with high accuracy after this part of the cycle is complete. Market cycles also rarely have concrete beginning and end points. As it turns out, being in the present moment is an exceptionally biased viewpoint in the financial markets.